Before we start, a quick disclaimer. I am not a financial advisor, and this video is for education and entertainment only. Nothing here is investment, tax, or legal advice, and nothing here is a recommendation to buy or sell any security. Leveraged products in particular carry a very high risk of loss, including the total loss of your capital. Past performance is no guarantee of future results. I may hold some of the assets discussed. Always do your own research and consult a licensed professional before making any decision. Here is a result that sounds impossible. An index goes up, then comes back down to exactly where it started. Net change, zero. But a 3 times leveraged fund tracking that same index ends the period down. Not flat, down. You were right about the market going nowhere and you still lost money. This is volatility decay, and once you understand the simple math behind it, you will never look at a leveraged ETF the same way again. First, what these funds actually promise: a 3 times leveraged ETF does not aim to give you 3 times the return over a month or a year. It aims to give you 3 times the return of the index for a single day. The word that matters is daily. Every single trading day, the fund resets its exposure back to 3 times, regardless of where the index closed. That daily reset is the whole story. It is what lets the fund keep its promise day to day, and it is also exactly what destroys value when the market gets choppy. Let us do the simplest possible example. The index falls 5% on day one, then rises back the next day to exactly where it began. Start at 100. Day one, the index drops 5% to 95. The 3 times fund drops 15% to 85. Day two, the index climbs from 95 back to 100. That is a rise of about 5.3%. The 3 times fund rises 3 times that, about 15.8%. But 15.8% of 85 only gets you back to about 98.4. The index is flat. The leveraged fund is down more than 1.5%. Nothing went wrong. This is just arithmetic. Why does this happen? Because gains and losses in percentage terms are not symmetric. If you lose 10%, you do not need 10% to recover. You need about 11% because you are now working from a smaller base. Leverage magnifies this asymmetry. A fund that falls 15% needs roughly 17.6% just to break even. The deeper the fall, the more punishing the climb back. Every time the market zigzags, the leveraged fund takes a slightly bigger loss than the gain that follows can repair, and those tiny gaps compound day after day. There is a clean formula for the drag. The expected decay is approximately leverage squared times the variance of returns divided by 2. The key word is squared. A 2 times fund has a decay factor of 2 times variance. A 3 times fund is not just 50% worse, it is 4.5 times variance. That means a 3 times fund suffers roughly 2.25 times more decay than a 2 times fund, not 1.5 times. The relationship is not linear, it is quadratic. Double the leverage and you roughly quadruple the decay. Now, the part most people miss: decay is not a guaranteed loss. It depends entirely on the path the market takes. Watch this. When the index just chops sideways up and down, the leveraged fund bleeds lower and lower even as the index returns to where it started. But in a strong, steady, one-directional trend, the daily reset actually works in your favor. Each day's gain stacks on a bigger base, and the fund can deliver more than 3 times the move. Leverage is not simply good or bad, it is a bet on smoothness, a bet that the market will trend, not chop. This is not a theoretical worry. Look at 2022, a year that was both down and extremely choppy. The broad market fell painfully but survivably, somewhere around 18 to 20%. The Nasdaq 100 fell roughly a third, but a 3 times leveraged Nasdaq fund did not fall 3 times a third. It collapsed by nearly 80%, far worse than 3 times the index, precisely because the decay stacked on top of the decline. And remember the recovery math. A fund down 80% needs to rise 400% just to get back to even. Decay is the hidden cost, but it is not the only one. Leveraged funds are expensive. Expense ratios are often around 0.75% a year, several times what a plain index fund charges. On top of that, the fund borrows money to create the leverage, and that borrowing has a cost that rises with interest rates. So you are paying a high fee, paying financing costs, and fighting volatility decay all at once. In a flat or choppy market, those three headwinds can quietly eat you alive while you wait for a rebound that, even when it comes, starts from a much deeper hole. To be fair, leverage is not useless. In the right hands and the right context, it has a place. The honest use cases are short. A short term, directional trade where you expect a strong move over days, not months. A small, defined satellite position that you actively manage and rebalance. Or a hedging tool held briefly. What leverage is almost never suited for is a buy and hold, set and forget position in a volatile asset, because that is precisely the environment where decay does the most damage over the longest time. So, how might a thoughtful investor think about all this without anyone telling them what to do? First, treat leverage as a tool with a very specific job, not as a way to simply turbocharge a long term portfolio. Second, if it is used at all, size it so small that an 80% drawdown in that slice would not change your life. Third, match the holding period to the structure. Daily reset products are built for days, not years. And finally, always look at the path, not just the destination, because with leverage, the path is what determines whether you win or lose. To wrap up, a leveraged ETF promises a multiple of the daily move, not the long term move, and the daily reset means a choppy market can take your money even when the index ends flat. The decay grows with the square of the leverage, so a three times fund is far more dangerous than it looks. These are precision tools for short directional bets, not engines for long term wealth. None of this tells you what to own. That is up to you. If this helped clarify how these products really work, consider subscribing, and as always, take care of your downside first. Thanks for watching.